Okay, today we'll cover the second part of risk and return chapter, right? This chapter. Basically, last time we talked about the risk of assets, risk return trade-off, and the risk single stock risk. And today we will cover the risk in portfolio and capital asset pricing model, security market line part, risk and return in a portfolio content. These are the main part of today's lecture. Up to now, we analyzed, last week we analyzed the single stock risk and return, of course. And now we will start analyzing the portfolio risk and portfolio return instead of single stock, right? Our discussion mainly based on capital asset pricing theory. This CAPM theory, capital asset pricing model theory, is originated by William Sharpe in 1964. Since then, various aspects of this theory have been published. It's one of the widely used investment analysis tools. We do not cover CAPM in detail. Rather, we try to explain how risk should be considered where the stock and the other assets held in portfolio, right? Not only the stocks, but you may have the risk-free assets in your portfolio as well. In your investment course, you will cover this CAPM model in detail, right? Okay. You remember from the last week, we had a portfolio created with two assets, high-tech and the company X. Okay. Of course, the portfolio's expected return is the weighted average of these individual assets, right? The standard deviation is slightly different. We will cover once again. How do we calculate the expected return? Basically, expected return is the weighted average of two components. In this portfolio, we have 50% of high-tech company, and the expected return is the 12.4%, and the 50% of company X, which is 1% with a 1% expected return. So the average is 6.7%, right? So here is this is an alternate methods for calculating expected return. The first one is just expected return of these two parts, these two components. The second one is we can do it separately. So we know the probability of, probability of each alternatives, and we know the return of each alternatives and each probability, it's each scenario, right? So and high-tech companies, we are expecting to have minus 27% return in the recession case with the 10% probability, right? And here is the company X return, right, in each scenario. So if you invest 50% in company X and 50% in high-tech company, in probability, in recession case with the 10% probability, your return is 0%, right? If it is, so here is the 10% return, 0% return. So because the average of portfolio return is 0% with the 10% probability plus 20% probability with minus 7% and 13%. Let's take the average of these two, which is the 3% of the portfolio, right? Here is the 20% probability, 3% portfolio, and do the same thing for the other other cases, right? Then you can calculate the 6.7% of this portfolio expected return. So we have two ways to calculate it. Okay, right. But the calculating standard deviation is slightly different. It's not the weighted average of standard deviation of these two assets. We need to first calculate the weighted expected return of the portfolio, right? And based on this portfolio return, we need to calculate the standard deviation. This 6.7 should be percentage. I'm sorry for it. So do not forget to put a percentage here. 3 should be percentage, 6.7, these are all should be percentage, right? When you calculate the standard deviation of this portfolio, you end up with 3.4% standard deviation, which is much lower than any single assets, right? And the coefficient of variation also 0.51, which is lower than these two assets, individual assets, right? So if you cannot hear you, Letafet, please check your computer. Anyone has a problem with my voice? Can you hear me other than Letafet? No problem, you can. So let me write Letafet. Thank you guys. Let me write to the Letafet because she's not. I hope you can fix Letafet. Okay, good. Good. There was a question. Inam and Halil, yes, you were late. We talk about the exam. Sorry, you missed it. But basically, I will let you know that the exam will be, I mean, I haven't decided the exact time, but I will let you know the time. So don't worry. Okay, let's go back to this portfolio risk and return. As you have seen, the return is the weighted average of these two stocks, but the risk or the volatility is much lower than in terms of, I mean, in weighted average of these both stocks, right? So why do we have a less risk? Because we have a negative correlation between these stocks, right? Combining stocks in a portfolio generally decrease your risk. Okay. Any questions up to now? I guess no. Let's move on. We covered this part as well. So assume that we have two stocks, W and M, and these two stocks are perfectly negatively correlated, right? So means that if one has a 40% plus 40% return, the other one, M, has a minus 10% return. So on average, you have 15% return all the time, right? So it has a perfectly negatively correlated. One is increasing, the other one decreasing at the same percentage. At the end of the day, if you invest 50% and 50% of these two stocks, your return is, as you have seen here, 15%, like risk-free rate, right? Uh, in real life, it's not easy to find perfectly negatively correlated stocks, but as an example, so we have it here. If it is perfectly positively correlated, it will not affect your portfolio return and risk, of course, right? Because both are moving in the same direction. So in terms of decreasing risk, doesn't make any sense adding a perfectly positively correlated stock to your portfolio, right? It might be the case in the usual case, it's partially correlated as this one. So we have two stocks, W and Y, right? Our portfolio, again, the minimum is -10, the maximum is 40. So our range is in this, between these two numbers. But you have, as you have seen, we have more likely to have an average return, 15%, right? Compared to investing individually. So that's why investing in different stocks decrease your risk, right? Any questions up to now? Okay, thank you. Let's move on. So when you want to create a portfolio, instead of adding a stock, randomly selected stocks to your portfolio, you need to check the correlation, right? So the correlation, if it is perfectly positively correlated, doesn't mean anything else. You cannot decrease your risk adding those stocks to the portfolio. Uh, okay, diversification is something good. So, but what's the limit? Up to 40 stocks, you can decrease your risk, but after approximately 40 stocks, well, the effects will be limited, right? So here is the graphical illustration. So you have seen, let's start with this one. On a vertical axis, we have the portfolio risk. On a horizontal axis, we have the number of stocks in the portfolio, right? While you are adding new stocks to your portfolio, sorry for drawing, your risk start to decrease. You see, the 40 is the approximately 40 stock is the limit, because after 40 stocks, the effects is negligible. So there are some important points in this figure. The first one, as I told you, the number of stocks, which is the 40, 50 is the approximately the maximum number you can add to your portfolio. The other one is we have two components, two parts in terms of risk. One is after a certain point, you cannot diversify it. You cannot eliminate that risk, which is called the market risk. And the first part, the upper part, is called diversible risk. So our portfolio risk has two components, two parts: the market risk, non-diversible, and the diversible risk, right? You can diversify it by adding a more stock, right? Right. Of course, we need to choose low correlation stocks to our portfolio. If you add a high correlation, perfectly positively correlated stock, it will not decrease your risk. Non-diversifiable risk is the firm-specific risk. No, it's non-diversifiable risk is the market risk. It's not a firm-specific risk, like coronavirus risk. So you cannot diversify it. You can decrease this coronavirus problem risk right now. It affects all the markets at the same time. Not only a specific company, not only a specific industry, but a whole company. Right? So the market risk, non-diversifiable risk, is the market risk itself. Diversifiable risk, yes, you're right. Diversifiable risk, you can, it's firm-specific risk, exactly. So by adding a new stock to your portfolio, you can decrease your risk in your portfolio. Right, you're right, Cameron. It's diversifiable. Okay, this is the case. Why all the investors are not investing to all stocks? Then why not? There are a few reasons. The first one is the cost, of course, the administrative cost. Sometimes costs are more than benefits for individual investors. So that's why they are not investing to all stocks at the same time. The other one is index fund is already doing this. So invest in index fund. I mean, you don't need to worry about it. Many investors do that, yes. And the last one is some investors think that they can beat the market by stock selection. So that's why they are not investing in all stocks, but specifically they choose and try to beat the markets, right? Okay, then any questions related with this graph? Okay, assume no. Thank you very much. Let's move on. All right, as I told you, we have two components. One is the market risk, non-diversifiable. The other one is the diversifiable risk. The market risk is you cannot eliminate it. So it's measured by, right? And the diversifiable risk, so you can eliminate it by adding a new stock to your portfolio. Okay. Okay, let's start the capital asset pricing model, CAPM. Right. This model links the risk and required return. Right? So it suggests the security market line, SML, that we can calculate the required return for any stocks in our portfolio. Okay, how do we calculate it? So the required return, we have two returns, required returns and expected returns. Expected returns we did last week is based on the scenario and our expectation, right? It's expected return. And required return is based on this model, CAPM, capital asset pricing model. So how do we calculate the required return? First, we need risk-free rate, right? Plus risk premium times beta, right? So these calculate this, gives us the required return, right? Let's calculate it with our numbers. Let me explain the beta. What is the beta first? Beta measures the stock's volatility relative to the markets. Let's say if the beta is 10%, let's say the beta is 1, right? If the market goes up 10%, that stock goes up 10% as well, same as the market. If beta is 1.5, market goes up 10%, and this stock, specifically this stock, goes up 15%, 1.5 times more. So more volatile than the market, right? It might be 0.5, then less volatile than the markets, right? So it shows the risk level in a well-diversified, it shows the risk level of a single stock in a well-diversified portfolio, right? Yes, we'll come to this point, Cameron, right? So as I told you, might be equal to 1, or so it's same as the markets. If it is higher than 1, then riskier, more volatile than market. Less than 1, then it's less volatile than the market. Most of the beta are in the range of 0.5 and 1.5. Okay, can the beta of a security be negative? What do you think? Is it possible to have a negative beta? Any idea? Yes, no. Any others? No, no, yes. Well, okay, let's see. So what's the beta? It shows the volatility or the reaction compared to the markets, right? Let me show you. Right. So, okay, this is the last week's slides. Yes, I'm looking for this slide specifically. Let me finish the negative beta, then we'll come to the next question. You see, guys, we have a market's return in a recession is the minus 17, average 10, and the boom 38.0, and a company X, it's moving in opposite direction, right? So can we say that, I mean, one is increasing, the other one is decreasing? So can we say that we have a negative beta in this case? What do you think? Yes, right. So Roshan, Halil, Reshat, Letafet. So as you have seen, we may have a negative beta as well. Let me go back to our slides. So here is the graphical illustration, right? If right here is the average beta is equal to 1, same as the market, the low beta and the high beta of a stocks. Yes, as you have seen, we may have a negative beta, right? Yes, the ZI example, gold is the, and Recep as well, right? The gold is the, that's why everyone try to add their portfolio. I mean, in term, the fund managers try to add this gold their portfolio. You see, the gold price goes up while the all index, all the stock price goes down, right? So it has a negative relation between markets, right? It's difficult, very unlikely to find these kind of assets. The gold is the only example. I don't know any others, but there might be some others example, but it's very unlikely to have a negative beta, right? Basically, this is the I think negative beta is not attractive for the investors to some extent because it gives us less return than the risk-free rate. Not exactly less than the risk-free rate. We don't know. Think about the gold. For the few months, the gold price is going up. The return is more than risk-free rate. So it's not. It depends on the time actually, not an instrument itself. So basically, the beta is the slope of this regression line, right? As an example, assume that in the one of the year we have -5% in market rate, in -10% in our specific stock, right here. Then 12% in market and 16% our stock here, and the other one return is here. So when you draw the line, regression line, your beta is, let me show you, it's here, written here, 1.44, right? So this is the minus 2.55 is not, I mean, yes, the slope is 1.44 is your beta, basically, right? How do we calculate our beta? Usually the beta is calculated based on the past data, right? So we will talk about it, but basically we cannot see the future, so that's why we only have the past data, historical data. Then we calculate the beta based on the historic data. Let's check our stocks beta, right? For the high-tech company, yes, Reshad, you're right. Past data is not a good reference, but that's only we have. This is the weak point of this CAPM theory as well, right? We will come to this point at the end of this lecture. What about the beta for our companies? For high-tech company, our beta is 1.32. For T-bill, it's 0. So in any case, we have 5.5% return, right, in all options. And for company X, we have minus 0.87. So the market goes up, the company X goes down, the price of company X goes down, or vice versa. Market goes down, the price of company X goes up, right? Okay, let's see the other instruments beta, right? The first one, the first number is the expected return that was calculated last week, and the second one is the beta, right? The market return is 10.5 and the beta is 1% because itself, right? Company Y, the expected return is 9.8, the beta is 0.88. T-bill, the beta is 0, right? And expected return is always 5.5. And the company X with 1% expected return with 0.87 beta, right? So the riskier the security, the higher the return. So it looks like it's okay. The rank looks okay. right? Any questions up to now? Okay, good. So we can calculate, based on this CAPM formula, we can calculate the required returns, right? So this is different than expected returns, required returns. What do we need? We need risk-free rate. So this is a calculation, it's not an expectation. So we need risk-free rate, right, plus market risk premium, right, times beta. Roshan, it's not always the case. If the expected return is high, beta is always high. No, it's not the case. Because beta is calculated based on historic data, right? So you have the market return and the single stock return. So based on these two information, you can calculate your beta, but expected return is expected. I mean, your expectation. Sorry. So to calculate its security market line, we need risk-free rate plus beta times risk premium. Risk premium means the market risk minus risk-free rate is your risk premium, right? So we know that risk-free rate in our example is 5.5. It's given. The T-bill rate is the risk-free rate, right? The market index rate is the 10% minus 5.5%. So the risk premium is calculated by 5%. So from the previous slide, we know the beta. So we can calculate the required, not expected, required return, right? So here is the calculation. For high-tech company, the risk-free rate is 5.5% plus 5 times beta, which is 6.6. So altogether 12.10 is your calculated required returns. So this is not an expectation. This is calculation, right? Is it clear? Any questions? Clear. Good. Thank you, guys. So we can calculate it, all required returns, right? So for the markets, beta is 1 because it's market itself. Then the required rate is 10.5, right? For T-bill, beta is 0. So therefore, required return 0.5, same as the expected, right? Because there isn't any volatility in T-bill as well. Then with the negative beta, we can calculate the company X, and with the positive 0.88 beta, we can calculate the company Y, right? So these are the required returns for our assets. So let's see. We eliminate. We eliminated diversification risk. Well, what do you mean by eliminating diversification risk? Not take into account. Well, this is the risk bit, but this shows the risk in portfolio content. Single stock risk in a portfolio content. Single stock risk is standard deviation itself, right? If it's a single stock risk. But if you think about in a portfolio content, this beta gives the risk level somehow. It includes all risk levels. Yes, it's diversifiable and non-diversifiable. So because we are our reference is the market itself, and the market has the diversifiable and non-diversifiable risk. I mean, the markets. No, well, the market it's our reference is the market itself, right? So based on this market risk, we are calculating the single stock risk. Somehow it's clear, I guess. Somehow. So we are checking the single stock risk compared to the market, right? So R bar is the well, we have R hat here, the expected return, and the other one is the if I'm not mistaken, R bar. R, we are using R here, required return, right? So we have two returns, expected returns and required returns. No, Reshat, it's not, the market is the monopoly. It's not related with the monopoly. If you invest, let's say S&P 500, if you invest to S&P 500, same as the S&P 500, then your portfolio beta is equal to 1 because you are moving same as the market. Your portfolio moves same as the market. It's not related with the monopoly. The expected returns is our based on our the probability and our expectation. We calculated last week, right? This is the expected return, 12.4 for high-tech company. The required return is calculated based on this CAPM. Required, the expected return is everything is based on your expectation. It might be different for individual, each company, I mean, right? But for the required return, it's required. It's same for all of us. I mean, risk-free rate is the 5.5, same for all of us. It's not based on our expectation. Market return is 10.5. It's not based on our expectation. And the beta is given, so it's calculated based on the historical data of company and the markets. So again, it's given, right? So the required return, 12.1, is calculated return based on this CAPM formula. So we have expected return and required return. If your expectation is higher than required, right, like 12.4 compared to 12.1, then this stock is undervalued. Yes.
Yes, I wanted to ask if the expected return is higher, let's say we expect higher, but the required return is less, don't you think it is overvalued? I mean, we overvalue it because we expect it higher than the required one. Or it's other way around, like I didn't get it.
Okay. Like high-tech company, right? In high-tech company, so we expected 12.4, but the required is 12.1. Is it?
Yes.
Yes.
Okay.
Yes. Right. Please turn off your. Yes, thank you. Okay. Well, actually, this required rate is based on the market, the given rate, right? But even this is the given, your expectation is higher. So you are expecting to have a higher return, right? So in this case, if your expectation is higher, assume that you are expecting to have 20% in a, mm, let's say, single assets, let's say SOCAR, right? You are expecting to have a 20% return in 1 year for the SOCAR. And the market required return is, let's say, 10%. In this case, I mean, do you invest this stocks? Do you invest in SOCAR because you are expecting 20%? Why not? I mean, I'm exaggerating this, but you are expecting a 20%. Why not? It requires less, but your expectation is high. You are expecting a better result. Well, your reference should be yourself. I mean, not the others. If your reference is you, if you expect a 20% return, you should invest it, isn't it? So that's why it's undervalued in this case, right? Because everyone is undervalued, your expectation is much higher, so you invest those assets. If it is same, you don't, of course, do nothing. If it is less, your expectation is because you are the, I mean, yourself, your reference is yourself. If you're expecting less, then sell it, do not buy it. So in this case, in our portfolio, we need to increase the high tech, the value, the weight of high tech, and decrease the company X and company Y, and do nothing with the T-bill, right? So if you draw the security market line, right? Why not everyone trust only required returns? Uh, yes, I will come to this point at the end of the slides. Why it's not a trusty one. I'll tell you, but let's, for the time being, let me finish this slide first. When you draw the security market line, right, some of them is above, some of your stocks is above this line, like high tech, and some of them is below this line, like company X or company Y, right? So if it is above it, above this line, invest, increase those assets in your portfolio. If it is below it, yes, then it's good, right? If it is below it, decrease in your portfolio, the weight, decrease the weight in your portfolio, right? If it is on it, like market itself here, this one, if it is on the line, do nothing. If it is on the line, like T-bill, do nothing. Right. Then, how do we calculate the beta of the portfolio? Basically, there is no trick for this one. It's the weighted average of each individual beta, each individual stock's beta, right? 50% of 1.32 high-tech beta and 50% of 0.87 company X minus, right? So the average is 2.25, right? we can calculate it like this one, basically the weighted average of these. Right. Okay. Let me explain with we calculate the beta 0.225, right, for the portfolio. Then, based on this portfolio, we can calculate the expected required return, right? So 5.5% is the risk-free rate, 5% is the risk premium, times beta gives you 6.62, right? Again, we know that the required return of this portfolio is 12.10. We already calculated, and 1.55 for the company X and a high-tech company. So the average is again 6.62, right? You remember the expected return for this portfolio is 6.7. We did it, we calculated for the last time. And required return, sorry, let me say once again. Expected return is 6.7 and required return 6.62. So is it undervalued or overvalued? This portfolio in this case, are you invested in a such portfolio? It's undervalued. Yes, exactly, you're right. Right. So which factors change this security market line? Of course, the inflation is one of the important factors. Assume that the expected inflation increased 3%. What happened to your security market line? Shift to up. Why? Because your let me show you. Because your risk-free rate is not 5.5 but 8.5 anymore. It's increased with the expectation. Your nominal risk-free rate has been increased, so that's why your security market line shift to the up. What any other factors affects? Any idea? Anyone? Any idea what other factors? Okay, I'll tell you. Market risk premium. If your market risk premium is not the 5 but 8, right? If you change your market risk premium, right? Then your security market line again not shift but move to the up, right? Any questions up to now? Assume no question, all clear, I guess. Let's go back 2 slides. This one, right? Cameron? Okay, here we are calculating for CAPM, we are using CAPM, we are calculating the portfolio's required return. We do in the two ways. One is using CAPM, right? The other one is if you know the required return of a single asset, which is for high-tech companies 12.10 and the company X is 1.15, your portfolio, 50% portfolio, again, the same as, right? You end up with the same number. So you have two ways to calculate your required return. Okay. Okay, let me go back to the Tarana's question. Why do not everyone trust only required return? The main problem here in this model, we are calculating required return based on beta, right? Beta is a very important role for calculation. But the problem is beta is on historical data, right? So historical data is not always reflects the expectation about the future. Think about the mask producer right now, right? The mask, I mean, based on the historical data, the beta is not trusty data anymore for the mask producer, right? So that's why there are some unknown part as well. I mean, this is not the best one. That's why it's not the trusty one. Tarana. Well, that's all for today. Do you have any questions?